Well, thank you so much for joining us. I'm Marlon Bowling with you, your tour guide to the ag commodities. Happy Monday. Well, I want to open up our trading week by welcoming aboard Mr. Brian Hoops. He's the president of Midwest Market Solutions, and he is based in Springfield, Missouri. All right, lots of anticipation over the weekend about rainfall that would occur in the Corn Belt. From what I could judge, it seemed like it was centered between northern Iowa and parts of the central Corn Belt, and then you had a lot of rain in the southern plains that Tim Ross was talking about. But some of the driest areas didn't really get all that much. It was kind of interesting in parts of Nebraska and parts of, southwest Iowa, I guess. They pretty much missed out. So it's, again, a story of the haves and have-nots. So the market overnight, it started out lower, and this morning we're higher. How much is related to that?
Good morning, Marlon. Yeah, I think there's a good correlation to that rain event that you're talking about. We saw under pressure from some rain that did fall, plus the forecasts that generally look favorable for the crop for development through the end of August and into early September. It looks similar to last year's weather pattern where we saw some late saving rains come into the Corn Belt and help this corn and soybean crop out. Now, the question will be is how much benefit is it, especially to the corn crop. And I think there's not a lot of benefit to that corn crop. Some areas, yes, you'll get some air fill, but I think it's just too far along, too far gone, too much heat in the summer to really be a huge benefit to that corn crop. The soybeans could be a little bit different story where we see a lot of benefit to the end of this growing season. I do think some of what we saw overnight was a technical-based rally, and whether that continues or not kind of depends if these fund traders show up again to buy back short positions. We are starting to see a lot of technical strength from the standpoint you're trading above a 21-day moving average, trading above a 40. The 21 and 40-day have started to cross to a positive territory, and all that just begs for some short covering. Now, it doesn't mean it's an immediate rally, but it does lead to short covering by the fund type traders. And we saw that last week. We saw that overnight. And we should see that in early trade again this morning, despite any export sales. So the wheat market's a laggard. It's not seeing the same technical strength. It really doesn't see the same fundamental strength either. But it looks to be just a follower of what corn and soybeans do.
Well, let's see what the corn market did overnight. And let's bring up our quotes provided by bar chart here. And we'll see that we had September corn a penny and a quarter higher. We were at 6.27 and a quarter. December didn't move too much. It looks like it was only up a quarter of a cent in that overnight trade. The soybean market, we had September 12 and a quarter higher. Look at that, 15.01 per bushel, almost on the high of the overnight trade when we wrapped up. November was up 8 3/4 at 14.12 3/4. And let's check out what was going on in our wheat market. We'll start in Chicago, and we had the September contract going down 3 cents at 7.50 and a quarter. And Kansas City wheat, well, it hit the skids a little bit overnight. September was down 2.5 cents at 8.42 and a quarter. In that spring wheat market, we had the September contract down 2 1/4. It was at 8.72 1/2. And well, let's check out that cotton market too, because it has been extremely jumpy here the last couple of weeks. Well, we actually added to the gains a little bit. Overnight, we had December cotton at 116.19 per pound, and that was up 18 points on the day. By the way, the Dow Jones Industrial Average overnight went down 350 points. That could be significant this morning. And we had the U.S. dollar index higher again, 262 points higher. Look out, it's all the way up to 108.360 now on that September contract. We'll be back and talk more with Brian Hoops about our market setup for this week when we come back. All right, we're back talking with Brian Hoops. He is with Midwest Market Solutions. And Brian, Janet alluded to this a little bit ago when we opened up the broadcast about the cattle on feed report that came out last Friday. It came out after the markets closed, of course, so we won't know how the trade reacts to it until we open up here at the bottom of the hour. But I wanted to get your impression on the numbers that we saw. Now, in that on-feed report that came out, USDA had pegged the on-feed number at 101% of a year ago. That was real close to what they were looking for. However, the placements number kind of high, 102%. I think most analysts were looking for a drop. The average guess was 98.8%. That was a little off target there, and the marketings came in at 96%. That was about 1 point under the average trade guess. So all in all, do you think that'll be a bearish factor for today?
Well, I think it probably will on the opening a little bit. Looking at the bid ask this morning, we're probably 25 to 50 lower to start the morning session. Now, longer term, I don't know that it's going to give us a real lasting impact. The on-feed numbers were the second largest for the month of August since 1996. Placement numbers, as you mentioned, that was where a real bearish surprise I think could have occurred. We expected to see more placements, and this was even more than what a lot of people expected. So that's a little negative. But these cattle weights, the cattle that are being placed are lighter weights. And so it's not going to have a real bearish impact, I don't think, for a real long-term numbers. Now, what's going to be impacted would be this week's cash markets. The cash this week, I think, is just called just steady. The slaughter pace last week was only 621,000 head, so that is above the previous week, and but it's well below the 650,000 head that we usually use as a benchmark if packer demand is real aggressive. So maybe the packers starting to back off on some of their cash needs for the near term, but I have to believe we've done a good job as far as keeping our weights down, and we're starting to turn the corner on our biggest, heaviest supplies. If we can keep the packer demand and our exports fairly robust, we should be able to ride through some of these larger numbers and larger placements over the next several weeks.
Well, we saw the October finished at 145.25 last Friday, and it has been a big rally upward here for several weeks since about the 1st of July. I mean, do you think there is more upside potential? It looks like there is another high if you go way back to April there.
Yeah, there's certainly upside potential in here, but we want to acknowledge that there is a little bit of downside weakness here as well, especially if these packers start to cut their kills. That's really going to be what the key is packer demand going forward because we're going to have enough supply here to meet whatever demand is out there. It's just a matter of how much packers are willing to kill in these markets. We've seen their margins drop to under $100 a head, which isn't a bad margin, but if they do slow their kill speeds, that's going to prop up those margins once again. So in the near term, we could be looking at a little bit softer cash trade, and that it will weigh on the futures if that happens.
And we had the September feeder cattle Friday closing 52 lower at 184.75. Meanwhile, over on the lean hogs, when we wrapped up the week, we actually had the October contract 17 cents lower, but all the other months over $1 to the downside. December was down $1.02 at 84.15 per barrel, way off of its high. Well, we'll see how they open up here in just a few minutes. And Brian, thanks for the help this morning. Appreciate it. Brian Hoops of Midwest Market Solutions with a look at our Monday market open. Janet, I'll turn it back to you.